concerns when things get this uncertain.
Many vulnerable economies, especially out of Asia, who are so sensitive to high oil prices and to shortages as well, they have very limited days cover in terms of those reserves.
If the conflict lasts longer,
it is going to be further moves into the US dollar.
I think it would be even to be futile to try to spend all of this, all of our foreign reserves on defending the peso.
Oil prices in these local currencies are surging quite sharply.
You're going to see a significant consumer-led downturn because of higher energy costs, real incomes being hit.
Lots of countries have less than 30 days of reserves left.
Let's bring in Ven Ram, cross-asset strategist at Bloomberg Live. So Ven, very open remarks there from many of these strategists. Even if this war, or the US involvement at least in it, does end, the impact on these countries' currencies is not likely to anytime soon. What are you expecting?
I think we should prepare ourselves. Emerging market currencies should prepare themselves for a bumpy ride from here, Bonnie, because the surge in oil prices is above, materially above what anyone had factored in. Just a couple of months ago, the investors were bearish on oil prices. We were talking about $60 an oil a barrel. Now we are almost at twice those levels, and it's a huge shock to the system. And that surge in oil prices means a higher import bill for most of these emerging market economies that are reliant on oil imports. But what is compounding the problem, Bonnie, is the fact that these currencies have depreciated. So it represents a double whammy, not only of how oil prices surged, but the import bill has gone up considerably because the purchasing power of the local currencies has gone down. So, and all these economies, most of these economies went into the crisis with an import cover of about few months. So I think that, the longer the war continues and the higher the oil prices push up, the more unconventional will the central banks get in terms of handling how their currencies behave. Because we've already seen India impose a cap on the amount of open positions that banks can carry over. So I think that central banks are going to have to improvise this against this situation, because as the Philippine Central Bank governor was saying, this is not a tide you want to take on when universally the US dollar is bid. So I think it's going to be a pretty bumpy ride for the next few weeks at the very least.
And not only that, Ven, but the bond market yesterday started to price in the odds of a Fed cut again, right? So that could be a further blow down the line for some of these countries. Would they be able to take that on top of everything else?
Well, I think that they're grappling with a host of issues. One is the fact that, the deficits are going to blow out, and the current account deficit is a significant driver of action in all this. And I think that, the current account deficits are likely to worsen a lot more. The trade balance is likely to worsen a lot more, and that is going to put some pressure on those currencies. But at the same time, central banks won't be able to raise rates in their response to inflation, because I think that a bigger priority for them would be growth here, because the best chips that these emerging markets have is the growth card. And if with considerable growth, if your GDP is growing 6%, 5 to 6%, I think that you can service those debts, you can service those import bills and what have you. But if you're in an environment where growth itself is threatened, suddenly the deficits will accumulate, and that will pose a bigger problem, systemic risk for these emerging market central banks and currencies. So I think that is what I would be watching in the next few months.
Ven, it's a little bit funny, right, that today is the day that we learned that Greece is finally getting rid of its EM status. That'll happen in May of next year, but it took that long, 13, 14 years for Greece to actually come out of emerging market status thanks to the previous crisis, or a previous large crisis. Could we see the long-term effects take hold in some countries because of this crisis, just like it did with Greece, for example?
Well, I think Greece is a pretty unique kettle of fish, Bonnie, in all this. I think that they have worked tremendously hard to turn around their fiscal dynamics. When you compare Greece to what it is today, to what it was during the 2010-2011 crisis days. I think they've come a long way, and they've been prepaying their debt, which is a fantastic sign of confidence. And if you look at Greek bonds, they've actually outperformed some of the peripheral euro area bonds, and I think that they've hewn to their own path of policy prescription and made sure that the fiscal metrics are a lot better than they've been in the past decade or so. So I think that it is a very idiosyncratic story, and I expect the Greek fairy tale to continue in the coming months. And I think that their debt will kind of outperform the peripheral economies.
Yeah, it was for sure a marathon for Greece. Ben, thank you so much. Ben Ram, cross-asset strategist at Bloomberg M Live. Coming up, Nike slumps as global headwinds darken the outlook. We'll have more on the sportswear giant's challenges. This is Bloomberg.
The problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Now to some corporate news. Microsoft is said to be in talks with Chevron and Engine No. 1 on a natural gas-fired power plant in West Texas. Bloomberg understands that the proposed plant is projected to cost about $7 billion and generate 2,500 megawatts of electricity, making it one of the largest of its kind in the U.S. In a statement to us, the company said that there is no definitive agreement at this time. Monzo is shutting down its U.S. operations and will instead focus on the UK and Europe. The London-based digital bank announced that it will stop onboarding new customers and lay off about 50 employees. Existing customers can continue to use their accounts until June. Monzo first launched in the U.S. in 2020, offering a debit card and an app. And Bloomberg has learned that the maker of Germany's Leopard 2 tanks is gauging investor interest for an IPO. Sources say the company may raise as much as 5 billion euros, and this could make it Europe's largest first-time share sale in years. It comes as the German government signaled last week it would buy a significant stake in the company in the IPO. Shares tumbling of Nike in the post-market after it gave results yesterday. This after a surprisingly gloomy outlook for the year ahead. With me now is Bloomberg's earnings specialist, Chloe Melly. So, Chloe, Nike's outlook deeply disappointing the market. What happened?
Yeah, it really did disappoint. We've seen that in those shares that tumbling in post-market trade. And if we look at the numbers, it explains why. So it expects sales to decline as much as 4% this quarter, and that's compared to what analysts had expected, which was a growth of 2%. So we can see that big gap there that explains this investor disappointment. So it's facing a few different headwinds. There's really high inventories in some key markets like Europe and the Middle East. There's also this ongoing weakness in China, which is a market which has really been driven by discounts over the last few years, because there's been that real kind of economic slowdown there and the deterioration in the labor market as well. And then, of course, and that is something that we're going to be probably hearing more and more from consumer names over the next few weeks and months, is the disruption, of course, from the conflict in the Middle East. And that is really impacting business for Nike. And all of that, all of those headwinds have really offset what has otherwise been quite a resilient, quite a strong performance in the North American market. And so that's really reflected in those shares today.
Yeah, because CEO Elliott Hill came in, right? He was supposed to sort of turn this whole company around. And I guess, you know, he hasn't had that much time, but there was a lot of hope that him being an insider would really help. What does it mean for Hill's efforts to turn around the business?
Well, it complicates it quite a bit. So the turnaround plan really is focused on the core business and getting that back on track and really pushing deeper into categories like running and like basketball. And Hill has said that, you know, getting back to a really healthy sportswear category would be really key to Nike's comeback. But obviously, there's no timeline on that. There's also the need of reviving China, reviving the Converse brand, which has been really weak as well. So there's a lot of work to do. And Nike and the CEO has said that, you know, it's taking quite a lot of time and that things are taking maybe longer than he would like. It's a complex task, but that the foundation is stronger. So we'll see what happens. But in the meantime, this is really going to weigh on Nike shares, and we might see some of that read across as well for European sportswear stocks like Adidas, like Puma. So we'll be watching for that today as well.
Yeah, it'll be fascinating to see if there are things in common between all of the sportswear makers. Chloe, I know you're going to be watching European chip shares today as well, particularly after that massive rally. I mean, the SOX is now positive on the year by something like 7% when we were flat literally 2 days ago.
Yeah, absolutely. So we'll be watching some of those chip stocks in Europe today. Names like ASML, like Infineon, like other semiconductor names, and you know they have been having a very tough time over the last month because of the war in Iran, because of some of those concerns. But now that possible end to the war, into the conflict in the Middle East, is leading some of those chip names to potentially rally. We've seen that with Asian chip stocks, and so we'll be watching for any positive moves for those names in Europe as well this morning.
Right, and then will it continue into the Thursday session? Because yes, it is a holiday shortened week, but there's still another session after today. Bloomberg's Chloe Melly, thank you so much for setting us straight on all of those market moves. Plenty more coming up. Do stick with us. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Daybreak Europe. Let's have a look at some charts that show us a little bit of what went on yesterday, right? Because it was a fascinating trading day, one we'll likely be talking about for some time and using as a benchmark, just like we used the day after the so-called Liberation Day tariffs as a benchmark. So this is the TIC index, the New York Stock Exchange TIC index, at its highest level ever. This will illustrate a little bit the frenetic pace of buying, just accelerating throughout the day. And of course, with that came the crushing of volatility. So we had the VIX index above 30 at the beginning of the day and then below or around about 25 and change at the end of the day. So a massive move lower for the VIX index as well. We'll see what happens today. Of course, everything seems to be volatile these days. Let's look at Treasuries. Speaking of which, they've been a little more stable, though those yields have been coming down. As you can see, Treasury bearishness did pair some of that bearishness yesterday. So we did see a little bit more optimism coming back into the Treasury market. I will say, though, the swaps market still has about 6 basis points of cuts priced in for this year. So we'll see if that holds. Certainly the Treasury market repricing on a daily basis. And then what are foreigners doing? If we look at this chart, we'll see that they were kind of exiting a little bit before the war began, but that has just accelerated. And they basically have been fleeing, as we have put it, Fed custody, but essentially just dumping some treasuries for various different reasons, no doubt. All right, well, you can access, search and save all of the Bloomberg Terminal charts used on this show and across Bloomberg TV. Terminal subscribers can just use the function CHRT TV Go. Now, there are some other risk events on the horizon today, not least it being April 1st, so we need to keep an eye out for anything that might be considered an April Fool's prank, right? But at 10 a.m. UK time, we get euro area unemployment. That's February data. Then at 1:30 p.m. UK time, we get US retail sales, again, February data. A little bit later on, though, in the afternoon, we get PMIs out of the United States. And then we do have some central banks speak today as well. The ECB's Piero Cipollone speaks, and also the Fed's Alberto Musalem is going to be speaking. And later this morning, we're going to be discussing the succession challenges at Banca Monte dei Paschi with CEO candidate Luigi Lovaglio. You don't want to miss that interview. That's at 9:50 a.m. London time. 9:15 a.m. London time. The opening trade is coming up next. Do stay with us. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
Good morning. It's Wednesday, April 1st, hoping for no April Fools. And here's what's on the agenda. Risk appetite climbs as stocks and bonds focus on off-ramp signals. But oil stays above $100 with jet fuel stress in focus. And OpenAI is now worth more than $850 billion.
Anna, good morning. Welcome to the second quarter. That euphoria that we saw on Wall Street yesterday on the war optimism has been around the world. We saw it in the Asian session. We've got futures higher on both sides of the Atlantic this morning. Yields down across the Treasury curve. But as you say, oil on Brent still above $100 a barrel. Traders weighing the fact that you've still got troops from the US heading to the Middle East, and the Strait of Hormuz remains all but closed. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. 7:01 here in London this Wednesday morning. Let's get straight to the latest news lines around Iran and how the market, crucially, is digesting them. Because, Lizzie, you're right to say this has gone around the world now. We saw strength in the US session yesterday and certainly strength in the Asia session. We'll look for some more positivity in Europe. And it fades a little as we get to US futures, but they are still pointing in an upward direction. Is all of this warranted? Is some of this overdone? Is obviously the question we will ask in lots of different forms in the next 2 hours of the programme. But some of the lines that we have had that the market is focused on, the US is now saying it wants to get this done within 2 to 3 weeks, leave within 2 to 3 weeks. And in terms of getting it done, President Trump saying most of the ambition around nuclear objectives has been achieved, and that's where his focus is. And importantly, when asking whether the markets are taking this all, too seriously and driving up risk appetite too much, the fact that we have Iran signalling at least willingness to talk with conditions, but maybe they won't even need to talk, the fact that we have them signalling willingness for an off-ramp is being taken quite seriously by markets.
It is indeed. And so you have President Trump saying that a deal won't be necessary for the war to end. He says that regime change has already been achieved, although you could argue that it's the same regime with a different harder line leader at the top of it. He also claims that Iran now won't have nuclear weapons. So let's see what he has to say at 9 p.m. Washington time when the president addresses the nation tonight. As we say, stocks up around the world, bond yields down again, and it seems like we've seen the highs of the correlation between oil and treasuries now.
Yeah, I think it's really important to focus on the things that we are seeing move in markets a lot, and that is stocks, and then other assets where we're not seeing, and that takes us on to oil and commodities. And really this is important because, as you say, the Straits of Hormuz still all but closed. Whose job is it going to be to open that up? Well, the president seems to have his own ideas about that, and he doesn't necessarily think it's something the US should be having to deal with. But it is worth pointing out that it's not just Brent that's still over $100 a barrel. WTI is still over $100 a barrel. And just yesterday, we saw that $4 mark on gas prices over in the United States. All of that will matter a lot, probably, to the White House ahead of the midterms. So if we focus on energy prices, we haven't seen this big drop in oil prices, obviously, because of the Strait and the difficulty of still getting through there. And I'm focused quite a lot on things that matter to the real economy. So maybe away from Brent and away from WTI, think about jet fuel, for example. That surged, and we've seen that go to records for Europe, an all-time high. The price that Europe now pays for jet fuel, equivalent to $215 a barrel on crude, if we were to translate that into a crude price, which I thought was quite interesting. And sources are telling Bloomberg that Europe has enough jet fuel for April, But May might be a different matter.
Yeah, of course, Europe is the main importer of jet fuel. The president really lashing out at European nations yesterday, saying that you'll have to start learning how to fight for yourself. The US won't be there to help you anymore as they struggle to get jet fuel. So lashing out in particular at the UK and France. And the US is, of course, one of the top suppliers of jet fuel. He says that we should be buying theirs, but there isn't that much spare capacity for the US to ramp up its jet fuel exports. So a question mark around that. In terms of forcing open the strait, interesting report from the Wall Street Journal saying that the UAE would be willing to do that, to join the fight. It's the only Gulf Arab country that said that it'll join the naval force to try to reopen the strait. And interesting as well that you've got Asian nations so starved of energy at this point that they're willing to, and already are doing, buying Russian crude. And Russia, therefore, one of the main beneficiaries of the war, as you could argue China has been, both really another reason to say that this has not been a victory for President Trump.
Right, and really interesting, you mentioned that point about the role that the Gulf countries might play here. If the US does step back, if we don't have the reopening of the Straits of Hormuz, does that mean we just descend into more of a regional conflict? And is it left to Europe, to maybe places in Asia? Maybe there's a role for China in reopening the Strait of Hormuz, which takes us into all kinds of unknown territory. Let us talk about something else that is on the move this morning. So as well as the optimism around Iran driving Asian stocks higher, we also have a big focus on tech. And this comes in a number of forms. And we'll start with the OpenAI narrative. It isn't just this, but we've seen the largest funding round to date for OpenAI. It has a new valuation of more than $850 billion. So they've raised $122 billion. And it's a usual cast of investors in the sense of the big hyperscalers, so Amazon, and also chip suppliers like NVIDIA, SoftBank also in the mix. So this is suppliers, customers, a mixture of suppliers and customers. It's also leaving space for retail to get a bit involved here, perhaps being added to ETFs and allowing individuals via back channels to get involved in the fundraise.
Yeah, they're saying that this is more significant than an IPO, but it puts pressure towards an IPO. Most of Amazon's investments contingent on OpenAI going public or reaching that technological milestone of artificial general intelligence.
Love to see how they're defining that in the contract. Yes, exactly. It's an
Tom
incredible
McKenzie
line.
when you need him. But look, it's not just that. It's not just the optimism around the war ending that's raising tech stocks. You've also got the news that NVIDIA is taking a $2 billion stake in Marvell. And, of course, you've got the hopes that the end of the war will boost the tech shares that have been suffering. So Samsung, SK Hynix in Korea, both climbing about 10% and 9% respectively.
And we have, importantly for those names, we've also had some news out around memory prices.
Yes.
And we've been concerned about memory prices on a number of fronts. Yes, they were surging. This was to the benefit of these businesses. Then there'd been some wobbles around that story. Vulnerability to some new technology from Google, meaning that maybe there was a different story around memory. Now we are getting some confirmation that memory prices have been holding up, and so that does also play to the advantage of the likes of Samsung and SK Hynix. Let's tell you what else is coming up on the programme. Great guest conversations. We will speak to Magdalena Polan, PGIM's Emerging Market Macroeconomic Research Head. So in amongst all of this, the talk about the US leaving the conflict, where this leaves the Strait of Hormuz, where does this leave some crucial emerging market economies around the globe? Ben Gutteridge will be with us, Invesco Market Insights Strategist, through the fog of war. How does his investment strategy shape up? We'll certainly home in on those conversations.
Well, let's look at what else we're watching throughout the day. At 10 a.m. London time, we have Euro area unemployment data. Before at 1:30 p.m. London time, it's US retail sales data. And then we'll be hearing from various Fed speakers, Alberto Musalem and Michael Barr as well. And we also have that Artemis 2 launch expected to take place at 11 p.m. London time. Can't promise I'll be awake for that, Anna. And then, as we say, 9 p.m. Washington time, that's 2 a.m. on Thursday London time, President Trump will be delivering that address to the nation on the Middle East war.
Yeah, absolutely. So we will have that as fresh for the shows tomorrow, won't we, here in Europe? So 2 a.m. UK time on Thursday morning for that address from President Trump. Let's get up to date with some of the other news flow we're following this morning. The Greek stock market has been upgraded to developed market status by MSCI, marking a milestone in Greece's recovery from its debt crisis. It was demoted to emerging market status in the height of the crisis in 2013. The reclassification ratification due in May of 2027 is expected to widen the pool of capital available to Greek companies. The ECB President Christine Lagarde is said to have challenged US Treasury Secretary Scott Bessent's optimism that the economic fallout from the Iran war will be short-lived. Sources say it happened during a meeting of high-level G7 officials after Bessent played down the damage. Lagarde is said to have warned that the effects will be felt for a long time because so much in the Persian Gulf has been destroyed. And Nike shares tumbling in after hours, trading after the retailer gave a surprisingly gloomy outlook for the year ahead. The company says revenue is expected to decline by 2 to 4% in the current quarter and will be down in the low single digits for the rest of the calendar year. Nike cited increased inventories and disruption from the war in the Middle East. Analysts also pointed to weakness in Greater China and other areas. So we will be calling on the services of Andrea Felstead later to tell us what this all means. But we'll keep an eye on the likes of Adidas and others within that sports leisure space.
Yeah, so look for the European read across. Also, not just because of the war disruption to Nike, but also because you've got Nike pushing into China when it comes to golf, tennis, outdoor categories in China. So how much pressure does that put on their rivals like Adidas and Puma?
Yeah, absolutely. And a big task for the CEO, the relatively new CEO, Elliot Hill, over at Nike, down by 9%, that stock in after hours trade.
Well, coming up on the programme, sources tell Bloomberg that stockpiles of jet fuel in Europe could start to run out in May. We'll bring you all the details as the Iran war continues to cause ripples across energy markets. Plus, US Trade Representative Jameson Greer says plans for a summit next month between President Trump and China's Xi Jinping are on track. We'll bring you some of that exclusive interview later in the show. But up next, we'll be joined by Remy Olupitan, Head of Multi-Asset Growth and Income at Schroders. So if you've got any questions of your own for our guests, please do send them to us on IB plus BBTV Go. Good morning from London. This is Bloomberg.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The Fujera report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Right now, the headline, bad news, is bad news.
This is a stagflationary mix.
It's a double squeeze for the rest of the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The market is tightening financial conditions.
It's not just what's happening present day. It's 5, 6, 7 months out.
The longest first quarter ever continues.
The March Jobs Report, Friday on Bloomberg.
I had one goal. They will have no nuclear weapon. And that goal has been attained. They will not have nuclear weapons. But we're finishing the job. And I think within maybe 2 weeks, maybe a couple of days longer to do the job. But we want to knock out every single thing they have. Now, it's possible that we'll make a deal before that.
President Trump giving an update at the White House on a possible end date to the war in Iran and suggesting the U.S. has largely accomplished its military nuclear goals in the region. The White House says the U.S. president is set to address the nation later today, this evening, in fact, U.S. time, to provide an important update on Iran. Let's bring in Bloomberg Horizons anchor Jumana Basechi. He is, of course, in Dubai for us. Jumana, talk us through the latest developments. President Trump there setting out some timescales.
That's right, Anna. And from the very outset of this war, I think lots of people have been asking exactly how long the U.S. intend for it to go on for. Yesterday, once again, President Trump spelling out a time frame, suggesting that in their eyes, it will take another 2 to 3 weeks to complete their military objectives. And what's interesting here is he specifically referred to the nuclear objective, which is that Iran should never have the capability to go on to develop a nuclear weapon. And he says he thinks that they can achieve that goal in the next few weeks. What was not mentioned, I should say, is the fate of that enriched stockpile. Remember, Iran are sitting on about 400 kilos plus of this enriched uranium. He did not bring that up. Second point is he also seemed to suggest that this could happen irrespective of whether there is a deal with Iran or not, which is interesting because he seems to imply that even if Iran don't come to the negotiating table, U.S. could unilaterally decide to end military operations in a couple of weeks' time. And again, we don't really know what's happening beneath the surface with the diplomatic channels, despite the many mediation attempts that have been put forward by Pakistan. So that's something to bear in mind as well. And then the third point is the Straits. And I think it's become very clear in the last 24 hours is that the White House is making a clear delinking between the military objectives on one hand versus the future of the Straits and who controls the Straits on the other. And President Trump quite literally said yesterday, we're not going to have anything to do with it. These countries like China, they'll go up, they'll fill their ships, and they'll leave and they'll take care of it themselves. There's no reason for us to do it. So really trying to extract themselves from the issue of reopening the Strait of Hormuz, which if you look at the price action today in markets, is perhaps reflective of that because, you know, investors are beginning to price in the possibility of a real end to this war militarily in the next few weeks. But as it pertains to energy markets, we still don't have clarity on the fate of the Straits.
And Jumana, you have the Wall Street Journal reporting that the UAE could be willing to join the fight to force Hormuz open. How fundamental a shift is that from the UAE to be just so much more assertive?
Yeah, well, let me just tell you and remind viewers that out of all of the countries in the Gulf, the UAE has intercepted and received the most incoming projectiles coming through from Iran, way above any other country. So, you know, this is the starting point. And if you listen to some of the official commentary that's come out over the last few days, certainly one of the key messages is their resolve has been hardened. And it was only a couple of days ago that, for example, the CEO of ADNOC, the state-run energy firm, likened Iran's grip over the Strait of Hormuz to economic terrorism. It's no surprise then that they are looking for a more long-term solution to what Iran is claiming as sovereignty over the maritime choke point that is known as the Strait of Hormuz. This would be an unacceptable outcome for many Gulf nations, including the UAE. So Wall Street Journal reporting overnight that the UAE and perhaps alongside Bahrain are putting forward a UN Security Council resolution in order to get involved in the reopening of the strait, perhaps by force. There are many ways that they could do that. One of the options being considered is for the U.S. to use some of the smaller islands close to the Strait of Hormuz, including the islands of Abu Musa. This is a contested island between Iran and Abu Dhabi going back multiple decades, but that could be a launch pad for the U.S. to launch their own series of attacks, perhaps on the strait. They could participate in minesweeping exercises as well. These are some of the options being put forward in that Wall Street Journal article. But the point here is that from the Gulf Arabs' perspective, an outcome in which Iran still manages to exercise that control over the strait is not acceptable.
Jemana, thank you very much. Bloomberg's Jemana Basechi there in Dubai. Let's bring into the conversation Magdalena Polan, Head of Emerging Markets Macroeconomic Research at PGIM, who joins us now. Magdalena, nice to have you with us. Thanks for joining us. Now, you join us on one of those days where the market seems to be buying into the idea of off-ramps from the US, off-ramps from Iran potentially as well. And that's gripped the market, and we see a lot of risk appetite. From your macroeconomic EM perspective, do things look better this morning for the emerging markets that you follow? What's your perspective?
Yes, any sign of resolution or the end of the conflict, and especially reopening of the Strait of Hormuz, would be very positive for the market. So anything that creates this sustainable relief for the market would probably change both the views of investors and the market. But we've had a few of these events so far, so I think any reaction will be very quickly verified by the actual events.
And I suppose, emerging markets are not a monolith. We had that conversation earlier on this week as well with another guest. And there are some emerging markets that have been benefiting from higher commodity prices. There are others that have been facing quite quickly terms of trade shock because of importing energy and are now thinking about energy shortages. Where are you worried about in the emerging market space on the idea that if the Strait of Hormuz does not open, we're still dealing with global shortages?
Yes, you touched on a very important point. So emerging markets are not a monolith. And in this particular case, it's a shock that affects the global economy. It just does not affect emerging markets only because the whole world consumes oil and gas and the commodities transported by the Strait of Hormuz. But indeed, the emerging markets tend to have fewer buffers and generally do suffer from these shocks more. And we've seen that with the inflation shock happening, with the potential shortages emerging, especially in Asia, countries have taken these regulatory steps to reduce the risk of acute shortages, so cutting working hours, restricting supplies, restricting energy sales, cutting just the working week as well. So that's quite unique because in the previous episodes of energy price increases, we did not see that. But this is a very unique shock. This is not just price going up. This is actually supply being constrained by such a large amount.
So that's not a fiscal response. It's not a monetary response. It's a regulatory response. Markets perhaps underestimating how much that'll weigh on growth.
Yes, that's true. And also, contrary to what we've seen in the past, when we had these oil price shocks, regarding of the level right now, growth shocks will follow after some time only. And then if you have this regulatory response, growth shock may actually follow much faster than in the past because we haven't seen rationing. We saw a little bit in 2022 when Europe was cut off from Russian gas and oil. And now especially Asia is facing a similar shortage as in 2022. So it's a very different model than we are used to.
Yeah, I thought that was a really interesting point in your notes that, there are closer parallels to 2022 in Europe, the gas shock, than for the rest of the world because Asia's more dependent on Gulf energy now. How severe could that shock be? And is it coming west?
That's a very good question because with damage to, for example, Qatar infrastructure, Qatar may not be able to just export the gas that it's due to sell to, for example, European buyers, and may invoke clauses in the contracts to stop deliveries. And then those shortages will also hit, for example, Europe and other countries. Also, some ships are still at sea, but they will reach the destination soon. And then Europe and other countries will see what happens afterwards. Luckily, this is now spring. The summer is starting, so demand for gas will be lower, at least from the heating and electricity generation perspective. But this would also be the time when most of Europe starts to refill the tanks.
Yeah.
So this may start driving prices and those shortages in Europe later on, as long as the conflict continues, and probably will stay for a little bit longer because there's also been damage to infrastructure, and this will take time to reopen.
Yes. And through all of that, we've talked a lot about Europe's level of impact from this, and also in Asia, the level of impact we see from shortages in Asia. What about China and its resilience? Are you tempted to tell a story about resilience, Magdalena, or do you tell a story about vulnerability when it comes to China?
So there are two things to it. One is the pure size of Chinese economy. That always helps in situations like that. The other one is that China entered this situation with relatively high storages of energy, so that also helps. And also the energy mix is different. And here, paradoxically, that old model of relying on rather dirty fossil fuels like coal and others helps, right? Because you don't need gas. Gas is still used for industrial purposes, and that hurts growth. It's used for district heating in many places, especially in the north. But otherwise, that mix, the size, the diversity of its own sources helps it in this conflict.
Magdalena, I note your scepticism at the start of this conversation that whatever President Trump is signalling, it may not mean it's the end of the war. If the war does continue, to what extent do you expect EM central banks to be cutting their holdings of US Treasuries to get liquidity? And also, because of a reduced, confidence in the US, given the flip-flopping that we've seen, frankly, out of the White House?
We've already seen that some of the central banks were selling some of the treasuries, but there's also been a drag on EM reserves because of the market reaction. So at the start of the conflict, there was an almost uniform outflow from quite a few emerging markets, local markets. And that put some pressure on reserves. We've seen reserves falling in places like Turkey, but also other countries much more developed with liquid markets saw these outflows. So that definitely put a drag on reserves. The other one will be whether the conflict continues and there's continued pressure. Also, countries in the Middle East may have to raise some liquidity to cover some of the fiscal and other needs. These countries have ample reserves. They have huge war chests and assets that they can mobilize for that. But obviously, the data we see is rather aggregated. We cannot really see who's doing that. But definitely, we saw that EMs needed cash to intervene in the currencies and to smooth this outflow. But what it also showed you is that EMs and other countries have quite high reserves. They cover their needs. They are not under high pressure. So that proved that the chests are working.
OK, Magdalena, great to have you with us. Magdalena Polan, Head of EM Macroeconomic Research at PGIM. And coming up, we'll check in on markets after European bonds open. Stay with us. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is the opening trade Wednesday, the 1st of April. Let's have a look at the bond market picture for you. And we are seeing significant movement in the bond markets. No evidence of any April Fools here. We are down quite considerably on these yields. So bond buying taking place once again. This week has looked really different for bond markets versus the other weeks that we've been covering the war in Iran. So we see substantial movement lower in these bond yields. Lizzie, in particular, Italy down by 13 basis points at the 10-year. The French market we see down by 10 basis points. So we are seeing substantial movement, and it isn't just at the 10-year horizon, actually. We see across the curve moves lower in yields, bonds being bought, and that really does echo what we saw in Treasuries over the last 24 hours.
Yeah, and in the mood of that risk-on euphoria that we saw on Wall Street yesterday, taking a look at the futures picture now, we've had the S&P notching its biggest gains since May. We've seen Asian stocks jumping the most in a year, the MSCI Asia Pacific Index extending its rally to 5%. And as you can see on screen here, futures pointing higher in Europe. We're playing catch-up here, so we're up 2.7% for Euro Stoxx 50 futures. Gains as well in London and Paris expected. S&P E-minis still up 0.7%. We've seen the euphoria there, but it's set to continue on Wall Street even further today. But joining us now is Remy Olupitan, Head of Multi-Asset Growth and Income at Schroders, for analysis. Remy, good morning. Are markets overreacting here? We've had President Trump signalling the war could be over in 2 to 3 weeks, and yet there are still US troops in the region. It's still all dependent on Iran's essential guarantees. Are we being too optimistic this morning?
I think we ended the month with positioning very, very bearish. So what we're seeing is a short squeeze. The market is hypersensitive to news, so we'll all be listening to what Trump has to say this afternoon, and that is causing a lot of volatility, and that's going to be expected. For this rally to be sustained, however, we need to see credible action, credible de-escalation and a reopening of the Straits of Hormuz. So what we're seeing right now is a relief rally.
Mm-hmm. OK. I mean, you've taken profit already on commodities after the oil spike. Does that suggest that you're convinced the worst of the energy shock is now behind us?
Hopefully so.
OK.
But it's hard in this environment to have that level of conviction. And so what we have seen with energy prices is a spike, and we have taken profit, but we still have a balanced exposure in the portfolio because, unfortunately, we think that we are in an environment of heightened geopolitical risk. And so there is a case for having some exposure to commodities in portfolios. You'll need it.
OK, and Remy, thinking of, as we go around the assets and how you're positioning in them for what has been a very volatile time and could still be volatile to some degree, what about your bond market expectations? We've been talking this week, you take, yes, everyone sighs at this. It's such a big change we've seen this week, where previously we focused on inflation, now we seem to be focused on growth risks and also risk on. So bond markets have responded accordingly. Yields have really come down, but you expect yields to go up again, I think, for the US 10-year at least. So what are you expecting to see there?
We're very nervous about bonds, and to be brutally honest with you, it's extremely volatile. As you mentioned, we are seeing big double-digit moves in yields, so that makes it really hard to call. I think the challenge bonds are facing is it inflation? Is it a growth scare? And every day it seems to be a different headache, and that's one of the reasons why we are staying out.
Is it both? It's just a timing difference? Some people suggest, you know, the inflation impulse comes quickly into the narrative, the growth scare takes a little longer to filter through?
I like the way you mentioned timing, because the challenge is when this originally started, as investors, we assumed that it will take a matter of days, despite being told weeks. Now, the longer we have the Straits of Hormuz closed, the more we have to think about the growth damage. And I think that that's the problem bond investors are facing. And so the longer, the fact that we may have to wait many, many more weeks for the Straits to reopen, we have to start pricing the growth scare.
But on balance, do you think that it's more likely we'll get a Fed hike than a cut this year?
That's where I'm confused. So the market, if you think about what's priced, it feels as if investors have priced out cuts and are starting to price hikes, particularly in Europe. We think that that may be a little bit of an overreaction. And so it's tough for central banks, particularly the Fed, when you're debating both inflation and growth. At best, staying on hold.
It does seem, and we got this message from Powell not that long ago, not this week, but previous hearings that we've had with him. There's a real lack of conviction around the outlook from the Fed for reasons we can really understand. And we've seen that in the markets sort of flip-flopping around expectations for cuts and then hikes and then not sure and back to hikes. I mean, where does that take us, that lack of conviction, Remy?
That lack of conviction means staying on hold, staying put, because it's dangerous to react when things are changing. It's a very complex situation. As I mentioned, the longer the Straits is, there's no activity on the Straits, the more damaging it is for growth. So it's very hard for the Fed to make a decision now when we just don't know.
And Remy, we were just discussing this with our last guest, Magdalena. Do you think that the war's permanently damaged foreigners' perception of the US? And that's what explains the drop in Treasury holdings in New York by foreigners. You can see it on the screen there.
That's a very fair point. However, the dollar has been a safe haven currency, so that makes it, it's not necessarily the case. I think that the challenge for treasuries right now is the inflation problem and also a need for liquidity. So to some extent, the positioning, the sell-off in treasuries is due to a need for liquidity. So yes, a lot of central banks have had to raise cash for various reasons. But the fact that the dollar still appreciates in this environment suggests that no, not just yet. There is still a confidence in the US.
Yeah, we are just seeing a little bit of a retreat, but you're absolutely right. It has been gaining, of course, hasn't it? But just a retreat this morning, down around 2.3% on the dollar, which is of interest. And incidentally, we just see oil prices dropping through $100 a barrel on WTI since we've been on air, really, this morning. So down by 3%, as if the market is maybe taking a little more seriously, the oil market now taking a little more seriously, maybe what other markets are reacting to. What about stocks then, Remy? Because you are still overweight stocks, I think, still like stocks, despite all the reasons to be cautious and uncertain that we face.
Yes, I mean, over the medium term, we do think that stocks are the place to be, even if we have inflation, because that's where you get a real return. You just need to be careful the kind of stocks you own. Now, admittedly, we're seeing a relief rally, and with more information, this may we may see a reversal, so we just need to be careful here. There's still a lot of volatility. The market is still fragile. But if we look beyond the next few weeks, there is still a strong case for equities here. We do believe that growth will look through this. We do believe that a lot of companies will deliver strong earnings, particularly in parts of the US, not necessarily tech. Okay. So looking beyond that.
Where do you look then? I was going to ask you if big tech's where you want to be.
Not at the moment, actually. We think that this is the time to be broader particularly in the US, look beyond tech, and we think that some of the financials are trading at very attractive levels. Yes, there are some concerns with regards to private credit, but I think that there are some opportunities there. Outside of the US, definitely, particularly in parts of Asia, where we're seeing an improvement in growth, export growth out of Korea was pretty strong. So yes, we do have some near-term headaches because of the situation in the Middle East, but if we look beyond that, there are some interesting opportunities and good reason to be bullish on equity.
We're looking at Asia markets, I mean, to some degree, just catching up with Wall Street, although I note that US futures going higher as well. So Asia increasingly positive this morning, Remy, up 5% on the MSCI Asia Pacific. The Kospi up by more than 8%. And a lot of this reflects rebuying of some of these Asia tech themes that have been so popular in January, February. Physical tech around chips, memory pricing, is that part of the theme that you want to get exposure to in the Asian equity space?
Yes, absolutely. I mean, we're moving to a new phase of the AI theme. Absolutely, when it comes to the semiconductors, the physical, definitely. We think that there's still a lot of demand. When we hear in terms of earnings and reporting season, you're hearing a lot of demand there. So we think that that's definitely the area to be.
OK, Remy, thank you so much. Thanks for your time this morning. Remy Olupitan, who's the head of multi-asset growth and income over at Schroders. 7:39 here in London. Bloomberg opinion columnist Marcus Ashworth says that gold is currently failing as a safe haven asset, instead acting as a piggy bank for nations facing economic strain. He suggests there will be more volatility for the market ahead and joins us now. Good morning to you, Marcus. So why do you think that central banks are selling gold?
Well, I think it's fairly obvious in the sense that we've got idiosyncratic problems across different parts of the world. So normally you could break down emerging markets, for instance, by resource rich or resource poor. But, you know, if you're in Asia, you're struggling very heavily. Look at the Philippines, particularly from being shut off, even Australia from Gulf oil, whereas perhaps South America would be slightly different. But clearly we've seen Turkey already having to sell some gold. We believe even Poland's been looking quite strongly at it. You know, that's for defence reasons. So it's more breaking down what the problem, the squeeze is coming on economically. We are facing a potential quite serious growth slowdown, may turn into recession for some countries if this conflict continues for much longer. And that therefore means you've got gold, which is traded like a speculative Bitcoin type asset for the last year or two. That's been flushed out. And now you had a situation where the good news for a lot of reserve managements of central banks is that they've had a great winning asset for the last few years. Now the hour of need is here, the rainy day, what do you want to call it? Time to raid that piggy bank. So I just think it's more going to be a two-way market in gold rather than a speculative instrument that it still partly is. We see it today. Markets are stronger in the context of both stocks and bonds, and gold is up. That tells you it's no longer trading like a safe haven, but more like a, so I guess, reserve asset and something that can be taken out of a piggy bank when needed.
So we've got gold up today, Marcus, up by 0.8%, $4,704 a troy ounce at the moment. Where's the peak for the yellow metal?
Well, I think this is the interesting thing for gold now. I would say we're in a much more normal market. I would see completely logical arguments for it to go back up towards the top if things calm down. And there's still a diversification need that some central banks who don't need to raise money perhaps would add to gold and transfer out of other assets. Look, we've clearly seen problems in stock markets, bond markets, and even the dollar, you could argue, has not done as well as it could have done. There are very few safe havens which are acting as logically as they normally would. You know, energy supply shocks are difficult things to trade. So at the same time, I could see why gold won't go very far, could even go down a bit, because if as I say, some of these central banks start to turn around, the Middle Eastern won't want to raise defense monies. Lots of countries need money to pay for rising oil prices and energy costs coming through, particularly the second round effects. So there's a lot of different reasons. And of course, support currencies. That's why we see perhaps Russia and indeed Turkey having to step in, sell gold and support the currency. So lots of different reasons you could see. For once, a two-way market, it could go either way.
Yes, if central banks are selling gold, then, Marcus, one of the reasons they've been buying it, of course, had been to give them alternatives to the dollar, and it was part of the de-dollarization narrative. So if they're selling gold, does that suggest that the de-dollarization narrative has been undermined? I mean, maybe the fact we've seen such a strong rally in the dollar is undermining the de-dollarization narrative. What are your thoughts?
Yeah, well, I always thought it was nonsense to a degree anyway. But I mean, in the context of the whole, moving away from the dollar to what? Bitcoin isn't fit and able. Gold isn't a currency in the conventional sense of the world. And there isn't anything to really replace it. You can see that usage of the euro has actually gone down. China, for whatever reasons, has been quite probably the most logical haven in some senses through this crisis. But you still don't have confidence of return of your capital and the rule of law in a sense you might have elsewhere. So, gold certainly is got some attractiveness and that sense, and that won't go away. But I mean, clearly, if the needs of governments are higher, you have to sell your winners, the ATM logic, and that's going to put a cap on gold, I think, for quite some while. And I do think, therefore, it puts it back into a more normal and logical place it once was, and away from the huge speculative rush that it became for the last 2 or 3 years. Probably a good thing long term.
OK, Marcus Ashworth, our Bloomberg opinion columnist. Thank you very much for your opinions this morning. And President Trump's upcoming summit in China with Xi Jinping will be watched very closely as the fallout from the Iran war continues to cause shocks across global markets while threatening to strain the US-China relationship.
We don't see a need to change our policy. The Chinese want stability. We want stability. I actually see a positive agenda with China going forward, where we learn to manage our trade with each other, where we pick the kinds of things we want to be selling to each other, things that are mostly not sensitive, to avoid some of the national security elements that prove challenging in negotiations. I see stability with China over the next year.
US Trade Representative Jameson Greer speaking there, and we'll bring you more from that exclusive conversation in the next hour. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US, or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Welcome back. This is the opening trade. This is the extent of the optimism we see now priced into European equity market futures. So we really are expecting a solid bounce at the start of trade. The Euro Stoxx 50 futures picture up by 2.8%. FTSE futures, CAC futures, DAX futures, all expected to go higher, some of them by more than 2%. And Lizzie, it does seem as if the oil price now catching up with the things are looking better again narrative that seems to have lifted risk appetite around the world in other asset classes.
Yes, we now have WTI crude and Brent crude below $100 a barrel. 97.43 on WTI, 99.75 on Brent. We started this programme, mind you, with oil higher. So it does seem that traders are catching up to that positive narrative, that optimism on the war. Brent actually down 4.1% as things stand.
Yes, I mean, maybe the lines we're getting out of the US and Iran are a step in the right direction, even if they don't reopen the Strait of Hormuz right now. Let's turn to Adam Linton, who joins us for 3 minutes on the markets with his perspective on what's going on right now. Adam, good morning to you. So we see risk appetite getting a boost all over the place. Oil prices are now dropping, but even before that, we saw stock futures substantially higher for Europe. US futures look a little higher. Asia's had a really good session. Your perspective?
Yeah, so I think, throughout the conflict, we have seen kind of this dip buying mentality on good news, and overall markets have been relatively resilient, which is indicative of when the conflict is over, there's a healthy appetite to buy stocks. And events over the past 24 hours have clearly been a positive. Iran is now signalling, publicly a willingness to negotiate, which, has caught some off guard because it didn't look like they had a huge incentive to, with oil prices in triple digits. So yesterday may, potentially have marked the bottom in markets for the conflict, and it makes sense for stocks to rally. But there's still quite a few hurdles for the market to clear. We still don't know what Israel's response are going to be. Are they going to stop activities in the region? We still, don't know exactly what Iran's demands are. If they're the ones from last week, then there's a huge negotiating gap between them and the US. Then also we need to figure out what's actually going to happen with the Strait of Hormuz, because it doesn't necessarily seem like a massive priority from the US to get that reopened.
And that's the bit that makes it perhaps a surprise that we have oil reacting as well. We're just at 100 on Brent now. Are you surprised, though, that the FX moves are where things are relatively muted?
Yeah, I'm not necessarily too surprised about the FX reaction. I think we saw, from yesterday, we saw the kind of this mechanical, sell the dollar move where, risk appetite had picked up and kind of undoing some of the move that was seen throughout the conflict. But to your point about, Hormuz potentially still being closed, this is of note for the FX market particularly, because if people start trading relative growth aspects, as they have been doing, then all those countries which are net energy importers, we've got the Eurozone, we've got the UK, it's not necessarily the all clear from them. And as we've kind of seen, there is potential lasting damage for energy infrastructure, even if they do get Hormuz reopened. So therefore, we may not see central banks be as reflexive as equities are. And, even if, we do see some rate bets scaled back, markets aren't really trading relative interest rates. It's all about the growth outlook. And the US stands to still outperform relative to the rest of the world.
OK, thinking about the growth outlook, this has become the most recent preoccupation of bond markets, hasn't it? So it's not necessarily about the inflation fears as it was in weeks past. It's now seems to be about growth. Is that how we interpret the fact that we see lots of bond buying, sovereign debt in Europe in particular this morning, and yields coming down? The Italian 10-year yield down by 14 basis points this morning.
Yeah, it definitely makes sense that there will be some, buying of fixed income products. US yields are lower, and I think for the US it's the big story because it kind of could get them back on potentially cutting rates. But as you mentioned, the market has been increasingly focused on the growth outlook. I think what the market now needs to see is actually where does Brent settle. If it still settles markedly above pre-conflict levels, that still does provide a growth headwind for the rest of the world, and as such we may see some relative outperformance in US paper relative to other markets, and that's what we need to watch going forward.
Yeah, your colleague Ben Ram arguing oil above $120 a barrel would herald that next leg of bond selling. Adam, thanks for joining us. That's Adam Linton from Bloomberg's Markets Live team. Well, let's turn now to our stocks to watch this morning with Bloomberg's Chloe Melly. Chloe.
Good morning, Lizzie. Let's start with the chip stocks this morning because they have been really rallying in Asia. So there's a couple of things driving that. First of all, there's some data showing that prices for memory products are rising, which is easing some of those concerns that we've had lately about slowing demand for those products. And then also, and more importantly, there is this hope, of course, that the war in Iran might be coming to an end. And so that has led those Asian chip stocks higher. And we're looking out for similar moves today in those European stocks, given that they've been having, as we can see, quite a tough month over the last month. So definitely watching out for that today, and any relief will be welcomed by investors. Moving on to sportswear, and that could also be in focus today after Nike disappointed investors last night with quite a gloomy outlook. It's been dealing with ongoing weakness in China and has also mentioned the disruption, of course, from the conflict in the Middle East. And so some of the issues it's dealing with are company specific, but some of them also might not bode so well for the industry as a whole. So we'll be watching for any read across for the likes of Adidas and Puma. As we can see, Adidas has been doing just as badly as Nike, but Puma a bit more resilient. And finally, Future, the media company, could be having another tough day. The shares tumbled yesterday after it cut its outlook. It's been dealing with a slowdown in website traffic because of Google AI overviews. But today it got downgraded by Berenberg and Barclays. So we could see an extension of the weakness that it saw yesterday as well.
Chloe, thank you very much. Bloomberg's Chloe Melly with some of the stocks that could be in focus for us today. Lizzie, I'm reminded our guest earlier on, Remy Olupisan, talking about, maybe some of this is a short squeeze on European stocks. So I'm keeping that in mind. US futures, incidentally, are pointing a little higher. So it does look as if we might have another day of this. And with yields coming down, you wonder what that does to appetite for risk right now.
Yeah, when we look at the energy moves, so we have Brent still at $100 a barrel, down 3.6%. Keep an eye on the energy shares at the open. You had seen Siemens Energy indicated higher on TradeGate. VAR Energy indicated significantly lower on TradeGate against the Oslo close. Given that oil is just swinging around this morning, it'll be really interesting to watch oil sector, the energy sector this morning.
Yeah, absolutely. Basic Resources was the best performing sector yesterday. It was quite mixed for European stocks. Not a huge amount of direction. Today looks really quite different. How long that lasts, waiting to hear from President Trump, of course, later, much later this evening. The Open is next. This is Bloomberg.
To the minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
A few minutes until the start of the cash equity trading session for Europe this morning. It's a busy one. April 1st, still hoping for none of those April Fools. And this is the picture from the US session yesterday. And it's still instructive, still helpful for us in suggesting where we might go at the start of the European trading day. So this is the US session yesterday. This is where Europe closed. And so we see that the US markets took a big leap higher, a big step higher, after we got some further news flow out of the United States, in particular pertaining to the Iranians and the extent to which they were prepared to talk, at least signals that they may be prepared to talk, with a lot of caveats, with a lot of conditions. But maybe the US administration doesn't even need talks. It wants to be out in 2 to 3 weeks is the latest commentary coming through from the White House. So all of that adds up to something quite positive for risk appetite. So we're looking to price that in. And that goes a long way, Lizzie, to explaining why we are seeing futures for Europe considerably higher, up by 2.8% on Euro Stoxx 50. Expecting the DAX, which has moved so much on this story in general, we are expecting that to really bounce at the start of the trading day. Lizzie, what do you see in the individual stocks?
So a broad risk-on mood expected, but in particular gains expected for European chip stocks this morning, Anna. We've already seen gains for Asian chip stocks on the war relief, and that news that OpenAI has completed a deal to raise $122 billion from investors at an $852 billion valuation. We've also got an eye on sportswear companies, given Nike gave that surprisingly gloomy outlook for the year ahead, so watch the likes of Adidas, Puma and JD Sports. And then energy, very much in focus, of course, as we have oil swinging now below $100 a barrel on both Brent and WTI. Where will that leave the likes of Siemens Energy and Vår Energy, we ask at the opener?
Yeah, absolutely. And for these markets, energy does seem to still be something of a wild card here, Lizzie, because we were thinking about a positive start to the European trading day, expecting that, even at a time where oil prices were quite resilient and staying above $100 a barrel. They've most recently dropped below that. So what does that do to the European equity market picture? Things in flux. The energy price certainly in flux, catching up with the risk-on mood that we're seeing in other assets and dropping below $100 a barrel. So the Stoxx 600 is up by 1%, essentially, but we are waiting for a lot of markets to open. The DAX might take its time to open, and that is perhaps where we expect to see some of the real positivity coming through. In the meantime, the CAC 40 playing that role, up by 2.4% on the French market right now. Some of the beaten up luxury names, they could be in focus for us this morning, as they have taken some of this head on. Expectations around perhaps more difficult times. Sales in the Middle East region has been part of the narrative around those. So some of that maybe rebounds. Is all of this premature? Is some of it just short covering? We still don't have any signs that the Strait of Hormuz is going to open. What conditions will Iran attach to that kind of climb down? All of those questions still very relevant for markets, Lizzie, but right now markets are buying first and asking questions later, it seems.
They are indeed. All but one sector in positive territory this morning, and that one sector is energy. As you've mentioned, we've got oil prices lower now and energy as a sector down 1.5%. Losses for names like Total Energy, BP, both down about 2%. At the top of the basket, though, we have construction, we have banks, we have basic resources, all up about 3%. Tech not far behind, and I had said that we should be watching those European chip stocks after the gains that we'd seen in the Asian session. Indeed, for some of the chip names this morning, like ASML, BE Semiconductor, VAT Group, ST Micro, all up about 4% as things stand. Just turning to sportswear as well, because we'd flagged a potential European read across after the Nike earnings. We're waiting for Adidas to open, but Puma up 2.4% and JD Sports up 1.6%. I have to say, say, on a day as risk-on as this, those moves perhaps not that much to write home about.
Right, it's incredible, isn't it? The scale of the moves that we're seeing this morning. We still don't have the DAX open. We do have gilt markets open, though, and falling into line with the rest of what we're seeing across Europe, we are seeing a lot of bond buying in the gilt space and those yields coming down. So we're now down by 11 basis points on the UK 10-year gilt, and across the curve we're seeing those yields coming down. The 2-year down by 13 basis points. So we're seeing perhaps a little bit more movement at the short end, but a lot of pivoting in the bond market conversation, it seems, around what to expect from inflation and then from growth. How that plays out into equity markets is always something we're interested to think about as well. And we've seen some of the rate-sensitive stocks have been on the move substantially in the past couple of weeks as we saw yields go higher and then the subsequent drop back. But back to the stock markets, and technology is now the best-performing sector, up by 3%, Lizzie, as we think about what we've seen through the Asia session and where we saw a lot of that buying coming through. Let's get some deeper analysis of these markets. Ben Gutteridge, Market Insights strategist over at Invesco, is with us this morning on set. Ben, nice to speak to you this morning. So we sit here this morning with an incredible amount of risk appetite returning to these markets. What's your instinctive reaction to that? Is this overdone? Is it premature? The DAX is open, up by 2.9%. The oil price is now playing ball, catching up a little bit and dropping back substantially, down by 3-4% in this morning's session. What's your thinking?
Well, look, I want to be positive. You know, it's a good day when markets are showing such strength, and no doubt taking the lead from the geopolitical story that the US may look to withdraw from the Middle East, and that is a route to the Straits of Hormuz reopening, but it's not a definitive route. There is, as you sort of suggested, markets are reacting to the story but may ask questions later, and I think those questions will have to be asked. You know, what caveats will Iran attach to a withdrawal, and indeed may this make life a little easier for Iran to keep the straits closed if the US is withdrawing. Now, look, it may surprise you, I don't have a huge military background, but, you know, there are just simply lots of questions that are very difficult to answer, even if you have. And on that basis, you know, we have enjoyed an overweight equity position and an overweight international equities versus US, but we have been neutralising that of late. And look, we could be more bearish than being neutral, so there is some positive things we want to talk about. But at the moment, we'd probably be fading sort of market strength on this story.
OK, so this does not give you the confidence to become more positive, to turn that neutral into something more positive?
Not at the moment, no. I think we're going to need to see hard data that the Straits of Hormuz are reopening. And maybe people can look to a modest uptick in the numbers already. But, I mean, it is incredibly modest versus what we were looking at pre-conflict. And, of course, by the time it's fully reopened, the market would have priced all of that. So you can't just sort of wait for definitive evidence. But we're looking to get more positive from our neutral position. But this news is, I don't think, sufficient to catalyse that.
When it comes to bonds, Ben, you've basically argued that it's win-win, right? If it's a short war, then you don't get as much inflation. And if it's a long war, you get rate cuts. That's very optimistic, isn't it, when you have people warning about stagflation? Yeah,
win-win was probably a bit cavalier on my part. But so no doubt you've latched onto that. Look, I think there is certainly, if the oil price moves dramatically higher in the short term, I can't see bonds dealing with that very well. Maybe hedge funds treat it as a sort of a bit of a toy in that environment. Now, inflationary risks escalate, bonds have a difficult time. But I think there's some asymmetry building into bond markets, and we would be looking to build exposure. For exactly those points that I've made and you've raised, is that whilst the scenarios that could play out is that the Strait, reopens gradually or whatever pace, and some of those inflationary concerns dissipate. But at some stage, if the Strait doesn't reopen, these inflationary concerns morph into a deflationary risk, because just life is just so unaffordable for everyone that they just can't buy as much as they used to, and businesses can't afford to build inventory, and it's sort of demand destruction and activity takes a nosedive. So I'm not sort of ringing the bell on bonds today, but we would be building into a bond position, certainly if the oil price were to move higher, because we've no doubt yields would move higher on that news.
Where along the curve do you like? You're seeing double-digit falls, basis points, really across the curve, across the European continent this morning.
Well, I think on the basis that if the oil price were to remain elevated, indeed move higher, I think recessionary risks are going to be building, and therefore looking to buy longer dated bonds in that environment. We'll wait and see how the news develops, but if it gets more precarious, then I think buying longer dated bonds is where we will go on the curve.
A lot still hinges on this oil price, and without the Strait of Hormuz opening, as you say, it's difficult to see where this goes. But oil prices are reacting, down by 3.8% on WTI, 97.54. Brent price now $99, down by 4.3%. So if we don't have clarity on a lot of these things, then, Ben, where looks relatively stable is? Where do you hide out? Are there assets that you've been adding to try and hide from some of the volatility elsewhere?
Yeah, I mean, it's difficult to hide. I would have thought within our neutralising position, that means, replenishing some dollar assets. Dollar not actually acting like a typical sort of safe haven, more of a petro sort of currency, not being as resilient as it might have been in sell-offs in the past, but having dollar assets in there makes sense given sort of US sort of energy self-sufficiency. But like within asset classes, I think favouring like UK equities isn't a dreadful move, and it's one that we've been applying. We, of course, should these geopolitical strife come to a swifter conclusion than we're anticipating, then the energy prices would be under some pressure. But no matter what the outcome, we would say that there's going to be a geopolitical risk premium in oil prices, and that countries are going to replenish supplies and indeed build even greater surpluses into the future. And of course, resource hoarding, an environment where you're looking at sort of spheres of influence and not wanting to have bad actors in your supply chains, means I think the sort of materials and mining sector can do okay.
So buying the UK would be about large caps, not for their UK eco exposure. It'd be the global plays.
No, I would have thought the domestic story looks something to shy away from at the moment. The international exposure and the energy materials, yeah.
And how much is that because of the politics here in the UK? Because, of course, the government's under massive pressure to respond to what's happening in the war in Iran by supporting consumers and businesses in a way that perhaps it can't afford.
Yeah, I think the government finds itself yet again in a very difficult position, not least given its sort of core values, I guess, as sort of a left-leaning party, or maybe even more than leaning, and may have to commit to some support programmes that the bond market might start to question, and certainly if it wants to push hard on that envelope. But a lot of this isn't, at the blame doesn't necessarily lie at the door of the government here. Interest rate environment has been pretty precarious. The jobs market was starting to show some cracks already, and the inflationary burden, does leave the domestic consumer in a difficult place. Maybe the politics can help a little bit, but the bond market may undermine some of that support.
It's difficult to have conviction, is it, in 2026, Ben? Are there things we can have conviction about? I mean, the underlying growth story for the US economy around AI and technology and all of the things we got excited about in January and February, are some of those still there?
Well, I mean, I would have thought the AI capex story is something for the markets to have some concerns about. The speed at which that gets monetised, the introduction of debt to pay for that AI capex. So in part, that was one of the reasons why we were exposed more internationally away from the US, because of that sort of hurdle that other markets don't have to wrestle with. But there is some resiliency to the caps that markets might find some comfort in these more uncertain times. But you're right, I mean, it's very difficult to have conviction at the moment. It's a bit trite, but you have sort of conviction that markets will be sort of volatile, and in that environment probably calls for a bit of a neutral position. But some of the better days, as we're seeing today, come amongst some of the most difficult. So I don't think it's appropriate to get super bearish at the moment either.
And are you also one of these people who's worried about private credit and the contagion risks there?
I am not yet in the camp that suggests this is some sort of start of some systemic risk. We believe, speaking to our credit analysts, it is of a more modest scale, and that banks have done, one of the reasons that private credit has escalated is that banks have acted in a far more conservative position. So even if private credit challenges sort of escalate, the banks could find themselves still quite well shielded. But of course, it could have a knock-on effect on credit spreads and government corporate borrowing costs. So not a helpful outcome. But at the moment, it's not enough on its own for us to pivot, as I say, to a more bearish position on corporate profits.
OK. Ben, always a pleasure to have you with us in the studio. That's Ben Guttridge, Market Insight Strategist over at Invesco. Thank you. Let's turn now to the core six. How are they holding up on this risk-on day? Well, green across the screen, as you'd expect. Schneider Electric up the most, up 4.8%. Nestle at the back of the pack, only up 0.2%. But Novo, LVMH, Rheinmetall and ASML all up this morning. Let's also check on some of the individual stocks we should be watching this morning with Chloe Melly. What are your movers, Chloe?
Good morning, Lizzie. Well, airlines are having a really good morning today. Those are companies that, of course, had really felt the impact of the war in the Middle East. That is because of those flight disruptions and cancellations across some Middle Eastern hubs. But then also the fact that higher oil prices were expected to lead to higher fuel prices. So the fact that now we have got this hope of this conflict potentially coming to an end, that is coming as a huge relief. And therefore, we are seeing all of those airlines up in the green quite significantly this morning. On the other hand, the oil and gas majors are definitely struggling, and that is for the exact same reason. We've got this hope of the conflict coming to an end that is leading oil to extend losses, and therefore oil majors are struggling this morning, and we are seeing in particular BP down 2% this morning. Moving on to Babcock, and there had been a real pullback in the shares of that defense company lately, but Citi analysts have just said that it now is time to buy those shares. They've upgraded the company, and therefore we are in the green. We are up almost 6% for Babcock this morning. And finally, quite a tough day for Berkeley, the London housing developer, down 10%. And that is because it issued quite a disappointing profit outlook. And it said it would not buy any new land as long as the tax and regulatory burden on residential development continues, and would instead focus on existing land holdings. And so this is a very cautious outlook, and that has really disappointed investors this morning.
Chloe, thank you very much. Chloe Melly with a fast-moving stocks picture this morning. European equities really on the front foot then, up by 2.3%. We'll be back with some of the corporate stories that we need to pay attention to this morning. Nike slumps as global headwinds darken the outlook. We'll have more on the sportswear giants' challenges, what it means for European competitors as well. This is Bloomberg.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Welcome back to the opening trade, 8:17 here in London. European equity markets very much on the front foot, in particular the Xetra DAX up by 2.6%. The CAC 40 also up pretty strongly this morning. Let's talk about oil prices, where we are seeing a considerable retreat. We are down under $100 a barrel, certainly on Brent, 99.64. WTI dropping down to 97 as a handle. So both of those down by around 4% this morning. Took a while to get this kind of movement coming through in oil prices, playing catch-up with some of the more risk-on movements in other assets. But now we see it. Now we see that negativity around oil prices. Let's bring in Stephen Stachynski, Bloomberg's Asia Energy Team Leader. Good morning to you, Stephen, from London. So help us understand what we're seeing in oil prices right now. This has been described up until this point as one of the worst oil crunches in history. And so I was all set this morning to ask you, why aren't oil prices higher than they are as a result? Because $100 a barrel is a not unheard of level for oil prices, even in peacetime. And here we have war in the Gulf. So that was my question. And I suppose that is still my question, even though we have oil prices retreating, because we still don't have the Strait of Hormuz reopened.
Yeah, I mean, I think there's an interesting way that the market is kind of digesting the statement from Donald Trump overnight. I think there is an expectation he is going to have a press briefing or a media briefing on Wednesday, 9 p.m. Eastern time. I think there's an expectation that he'll maybe have some sort of hints or comments about how there's the off-ramp for this war. And then the oil market, I mean, according to the prices, it sure looks like there's an expectation that things will de-escalate maybe rather quickly after that. You could see maybe the Strait of Hormuz opening and then oil flowing again. But as you mentioned, why are we at this situation when the Strait of Hormuz remains shut? It's unclear how long or if it will open up. It's unclear exactly how long de-escalation will take with the U.S. We don't know what Trump is going to say next. He changes how he views the war, and he says one thing and then changes it to another thing. Administration officials do the same as well. And then also there's damage within the region. There has been Iranian attacks on oil refineries, on ships, on liquefied natural gas export plants. So all of that together doesn't really indicate that the Strait of Hormuz can open quickly. In fact, it could take weeks or months, according to analysts. So it does seem to be some sort of disconnect, and you're seeing it play out in other markets. Jet fuel prices in Europe have hit a record high. You're also seeing different products as well staying pretty elevated. So I think everyone's really just waiting to see what Trump does and whether or not there will be any action behind his words this time.
Yeah, when it comes to jet fuel, Stephen, we had the president saying that Europe will have to start learning to fight for itself. It's going to have to get its own jet fuel, maybe buy American jet fuel. How tight is the situation in Europe right now? And how quickly could the European situation actually turn into a shortage?
I think there's a very interesting happening between the crude market, which is, hovering around $100 for Brent, versus jet fuel, which is at a record high level. $100 Brent, not unheard of. We've had that before in the early 2010s. The market can digest that kind of price level. Jet fuel, though, seems to be quite an emergency level. And we had a really interesting report out of my colleagues from Europe that showed that, according to officials that they spoke to, Europe does have enough jet fuel to get through April. There are no risk of shortages for the current month that we're in. But if this continues into May, that's when you could really start to see some supply shortfalls and inventories depleting to levels where there could be shortages potentially. Again, if this all continues, there isn't as much of a buffer in the jet fuel market as there is in the crude market, right? We were entering the crude market this year with quite an oversupply, quite an overhang. U.S. supply had been very strong. We were talking about the year of the glut. We were talking not about $100 Brent. We were talking about $50 Brent. And here we are. So there was a little bit more slack in the system, and perhaps that explains some of the price movements over the last 24 hours. But jet fuel is a different monster, and it really depends on how long it continues. April seems to be in the clear, but May could be the month that really starts to tighten things and emergency flags sort of flying then.
OK, May the month to watch. Stephen, thank you for the update. That's Stephen Stupczynski, Bloomberg's Asia Energy Team Leader. Well, turning to retail now, we've seen Nike shares tumbling in after-hours trading after the retailer gave a surprisingly gloomy outlook for the year ahead. The company says that revenue is expected to decline 2 to 4% in the current quarter and will be down in the low single digits for the rest of the calendar year. Andrea Felsted, Bloomberg opinion columnist, joins us now for more analysis. Andrea, what seems to be the issue at Nike?
The issue seems to be the more casual, fashion-oriented clothing and footwear. We wrote a little while ago that we're all smartening up again. Sophisticated casual was in.
You told me trainers were out.
Exactly, and athleisure was out. And we're really seeing this. Nike's doing okay in the kind of things they call performance, which, you know, more comfortable running shoes, warm outdoor gear. But it's that fashion-oriented casual market that's really suffering.
And how does that complicate a turnaround that is being planned for this business by a relatively new CEO still trying to make a mark?
Well, he's doing very well, actually, on the performance side. He's had some wins in running. He's launching the ACG brand, relaunching it as a more gorp-core, out-core fashion brand. He's doing all the right things. He really needs a fashion hit because when sneakers are in, we're going for the more low-profile, smarter shoes, which favours Adidas more. The Nike Samba, the Terrace styles, although they're definitely past their peak, but they're refusing to die. They're still there. And Nike has been quite slow in tapping into that market. It has the styles, the Cortez, the Killshot, but it hasn't activated those enough because it's focused on performance. So it really needs a fashion hit.
Is it the Samba that's come out in a new T-bar iteration? Not for me. But look, we were looking at maybe there would be a European read across from these Nike results. We're not so much seeing it this morning. Adidas, Puma and JD Sports all up, along with that broader risk-on move this morning.
Yeah, Europe, they definitely said Europe was weaker in this sportswear business. So we're seeing these fears kind of play out in Europe. Not great news for Adidas, although I think actually Adidas is more protected because of its styles. The CEO, you know, I think he's really on top of all the fashion trends. He's been, you know, the Samba's faded, he's reactivated the Superstar, now he's going for the Stan Smith, which actually works very well with a smart casual look.
I will say I like a Superstar. I had those when I was at school. Glad to see them getting revived.
Nice retro reference. LVMH, I mentioned this just because we've got a lot of focus on luxury. At the beginning of this week, we were talking about the role that some of these big cap stocks and luxury, and LVMH was one of those, in Europe's retreat. And now they're playing a role in Europe's gains today. But what's at stake for the luxury sector at the moment, Andrea, as we watch the broader market narrative unfold?
Well, the Middle East is obviously an important market, but it's quite small. What is really important for these brands is what happens to markets, particularly in the US, because US luxury demand is correlated with stock markets, and we've seen US stock markets hit. If that gets worse, then that could be problematic for these luxury names.
Andrea, thank you very much. Bloomberg's Andrea Felsted joining us there with the latest on what's happening in the luxury space and indeed Nike. Let me talk about what's going on with aviation. We've seen some strength coming back to aviation, of course, and some of that is because of the weaker oil price. I mean, you've got an oil price that drops $97.58 on WTI, $100 on Brent now. I mean, this doesn't feel like the end of the story by any stretch. Still no opening of the Strait of Hormuz, but that is positive enough for airlines today, Lizzie, and we see them gaining.
Yeah, travel and leisure, the best performing sector better on the Stock 600 this morning, up by more than 4%. But as you say, it comes back partly to the oil price, and we're looking at Brent weaker than $100 a barrel, actually just on the nose at $100 a barrel for Brent now, down 3.7%. But WTI below that. And at the bottom of the sectoral basket on the Stock 600, you've got energy down 1.5%. Coming up, though, we're going to talk space. We'll be speaking to Mike Lockwood, president of the Royal Astronomical Society, as NASA prepares to send astronauts back to lunar orbit after more than 50 years. That conversation next. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Welcome back. This is the opening trade, 30 minutes into what is an incredibly positive session for European stocks. Is this all we need to know about today's market? We are up by more than 2% on the Stocks Europe 600. The DAX, the CAC, the FTSE 100 all gaining. Of course, exposure to energy for the FTSE 100 will hold it back just a little bit. And no surprise that we see the DAX getting the best of the gains this morning. But we spoke to Schroders earlier on. They were talking about short covering. Is that part of the story? We'll get into a conversation, Lizzie, in a moment about what is really under the hood and driving these markets.
We'll take a look at this breakdown, Anna. 544 members of the Stock 600 higher this morning compared to just 53 to the downside. As you say, this is a risk-on morning thanks to that war optimism. People piling in volume-wise as well. We're up almost 50% here today. Let's just take a look at some of the particular leaders because, yes, this is a broad picture across these markets, but outsized gainers include Novo Nordisk this morning, up 3.6%. The specific story here likely revolves around the news that the company is offering its obesity drug, Wegovy, more widely on England's NHS. We're also seeing gains for ASML, up 4.5%. It's the biggest gainer by points on the Stock 600 this morning. after that optimism that we'd seen earlier in the Asia tech trade. We had the OpenAI news, also, of course, the war optimism. Finally, on the leaders board, Siemens Energy up 6.1%, rebounding on that possible resolution in the Middle East. Of course, we wait to hear from President Trump at 9 p.m. Washington time later, but this stock has significant exposure in the region, so obviously reacting positively to that optimism. Flipping to the laggards this morning, Total Energy's down 2.7%, of course, because we've got Brent dropping on the prospects of a resolution in the Middle East. We were at about $100 a barrel on Brent the last I checked. Shell also down more than 2% on the oil price, and Berkeley here down 17% after the firm said that it'll stop buying new land because of an increase in tax and regulation on development. Anna.
Let's talk about some of the other stories that we need to keep across this morning. And in fact, we'll start with war in Iran. Donald Trump says he expects the US to end the war on Iran within 2 to 3 weeks. That's as a report in the Wall Street Journal says the UAE is preparing to help the US open the Strait of Hormuz by force. The White House says the US president is set to address the nation tonight to provide an important update on Iran. The Greek stock market has been upgraded to developed market status by MSCI once again, marking a milestone in Greece's recovery from its earlier debt crisis. It was demoted to emerging market status at the height of the crisis in 2013. The reclassification, due in May of 2027, is expected to widen the pool of capital available to Greek companies. And Nike shares have been tumbling in after hours trading after the retailer gave a surprisingly gloomy outlook for the year ahead. Nike cited increased inventories and disruption from the war in the Middle East. Analysts also pointed to weakness in Greater China and other areas. Lizzie.
Anna, let's dive back into the stock market picture. European equities rallying as investors eye an end to the Iran conflict. Are they right to do that? Bloomberg's senior strategist on the EMEA equity markets, macro trends and strategy team, Michael Masika, has been covering this on the terminal for us this morning and joins us round the table. Michael, I wonder if this is an overreaction or more personally, perhaps, whether it's sustainable, because we get some headlines out of the White House and Tehran and stocks jump around the world, but surely it could all change from Trump tonight.
That's right. It can definitely all change. Also, you got to look at the bigger picture of like what will be the impact on, oil jumping that high, of gas jumping that high, of what's going to happen with central banks and the monetary policy, the fiscal policy in Europe over the next few months. So overreaction, I would say no, it's not really an overreaction. It's more like a knee-jerk reaction because the positioning was so bearish getting into those headlines, which seems like the clearest we've got recently. There was a lot of fatigue in the markets, like flip-flopping, and like investors didn't know what to do exactly. But the reality was fast money, hedge funds, CTAs, macro hedge funds, they were all very, very short. CTAs got short for the first time since last April this week. This was like literally ready to rip on the first real positive news, and that's exactly what we're seeing.
That's what we got then. So there were a lot of short positions. We got a headline that looks as if it changes the direction a little bit, and stocks fly as a result. But what have we actually heard here, Michael? We've heard that the US is willing to leave, and we've heard that the Iranians are willing to talk. We have not heard that the Strait of Hormuz is going to reopen. Oil prices are reacting just like we're seeing risk assets react, and oil prices are considerably weaker this morning. But what is the link then between what oil prices do and what stocks do from here? Because oil prices may stall. They may say we need to see more proof of the Strait reopening before we can drop further from here. And then where does it leave risk appetite?
So that's the problem. If you have oil settling at like around $100 a barrel, you're going to have a huge impact on earnings especially for Europe. A bit less for the US, obviously, because the tech weight in the benchmark is much, much higher. But for Europe, it's very important. And if you have like suddenly, this year, the consensus expect like double-digit growth in Europe. If you have oil at $100 a barrel, you're not going to have double-digit growth this year. So, like I said earlier, like down the line, the impact is there's still a potential very high impact on European earnings and on the European market. But we'll see that later. I mean, if you look at what happened in 2022, for example, like the stock market went down, then on headlines it started to go up, and then it completely flatlined for a while.
Okay.
So that's the risk we're having today.
That is the risk. Michael, thank you very much. Bloomberg's Michael Masika joining us with a look at this fast-moving market story. Let's make space for something else today, shall we? Later today, NASA is scheduled to send astronauts back to the moon for the first time in over 50 years, around the moon at least. The Artemis II crew will test a spacecraft that's to play a key role in America's return to our lunar neighborhood.
I think our generation appreciates having a program that now we get a chance to take our own moonshots, what we call great things that humans accomplish.
NASA's Artemis program is the space agency's ambitious mission to send humans back to the moon for the first time in more than half a century. The last time NASA sent humans to the moon, they were locked in a space race with the Soviet Union. This time, NASA wants to go back to the moon to stay in order to learn how to live sustainably off of the lunar surface.
4-stage engine start.
Prior to Artemis II, NASA launched the very first major mission in the Artemis program, called Artemis I, which sent the Orion crew capsule around the moon to demonstrate that they could work without a crew on board. Now it's time to show that they can actually keep a crew alive while traveling to deep space.
Our goal is get to the moon and get back. 4 days out, 4 days back.
We are going to do as much science as we can on the way. And on the far side of the moon, we're going to have maybe 45 minutes where we're in a loss of calm with Earth. And all we can do is just train our eyes on that moon surface.
The entire Artemis program has come under significant criticism for how much time it's taking to build and how much money it's costing the taxpayer. There is an estimate that between 2012 and 2025, the Artemis program has cost roughly $93 billion. Despite the criticism, it does benefit from strong congressional support. Many of the programs that are needed for Artemis are spread across the entire United States and provide a lot of jobs for constituents. While the Artemis II mission is coming up, Artemis III, Artemis IV, Artemis V are all a bit of open question marks at the moment. There's development that needs to happen for hardware, notably with the landers that will actually take the humans to the surface of the moon. NASA is pulling out all the stops with its contractors to ensure that a landing occurs no later than 2028, but it remains to be seen if that date will actually be possible.
For more analysis, we're joined by Mike Lockwood, President of the Royal Astronomical Society. He joins us now. Good morning, Mike. We heard just there some of the concerns around the cost of this mission. I wonder how you justify that $93 billion and counting price tag, and whether Artemis has just become too expensive to fail at this point.
That's a good question. Scientifically speaking, we can do exploration just as well with robotic craft. The thing that you get with manned missions is inspiration. You get, well, I myself, my career started when as a schoolboy I came home and on the news there was this young American president talking about going to the moon and doing the other things because they're hard. And I thought, wow, I'd like to be part of that. And so the inspiration side of it and bringing young people into science and technology is really important.
Good morning to you, Mike. It might be important, and do you think that we will see a similar effect this time around? This hasn't happened for decades.
That's a very good question.
Haven't sent people into deep space for decades, but we have done it before. Will it have the same impact in 2026?
That is an extremely good question. There seems to be a lot of interest, and so maybe it will, maybe it will. But as you say, I think the dangers of failing this time are much higher. I think there will be a lot of adverse reaction if Artemis fails, and I do worry about that. But for me, that's the big benefit. The big benefit is to inspire young people into science because we need them. They're the future wealth generators for the world.
Mike, you've got a lot of billionaire-backed space companies getting involved with this. Do they accelerate progress or do they complicate it? I'm
not sure either, really. I mean, a lot of the commercialization of Artemis is in the the mechanics, is in the building of the craft, is in the operations and things. And there's no reason why that shouldn't. I'm quite sure that the process can be made to run as smoothly as it did with the state-backed system of the original of NASA, or the state instigated, state-controlled system. I don't think it's a great complication because if you're going to do anything in space, everybody has to pull together, everybody has to work together. What I do worry about is we have an outer space international treaty, and I do think we almost need to think about having a treaty for the moon that very much mirrors that we put together for Antarctica. And that happened 50 years, the Antarctic Treaty was 50 years after the original exploration missions. So it's kind of about time to think about that. And my big hope for Artemis is actually a geopolitical one. It's not a global mission, Russia and China are not included, but that it will drive some international agreement on sustainable behavior in space, because we really badly need that. The space junk problem in near-Earth orbit is beginning to turn critical, and we really do need a beefed-up international space treaty, and maybe Artemis will help us produce that.
Right, yes, and we'll see if the mood, the geopolitical mood on Earth can produce that for us, Mike, despite plenty of disagreement here closer to Earth. Thinking about the international involvement in this project. International involvement, of course, the Europeans are not absent from this project, but they were particularly focused on the Gateway, the mini space station that was supposed to be accompanying Artemis later on in the project, that now has been called into question. Is Europe at risk of being cut out here?
I can't answer that. I hope not, because the more international this program is, the better. What you really don't want is a colonizing frontier mentality to set in, and then the moon could become a political flashpoint. So that's the last thing you want. So the more international it is, the better, quite frankly.
Mike, thank you very much. Thanks for joining us. Mike Lockwood, President of the Royal Astronomical Society, as we look ahead to that mission, Artemis 2, later on today. Coming up on the programme, back to the technology conversation here on Earth, and OpenAI's valuation tops $850 billion after a massive funding round involving the likes of Amazon, Nvidia and SoftBank. More next on its plans for all that cash. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Welcome back to the opening trade. 47 minutes into today's session. As you can see, it is green across the screen this morning following the euphoria that we saw on Wall Street yesterday on the optimism that this war in the Middle East could be coming to a close. We have the Stoxx 600 up 2.4%. Particular gains for the DAX in Frankfurt up 2.7%. The FTSE 100, the laggard somewhat, it's still up 1.7%, but that comes down to the oil price. We are looking at Brent just below $100 a barrel at 99.72, down more than 4%, and WTI crude also below 100 at 96.77. So the energy exposure here in London, meaning weakness for London stocks.
Yeah, let's talk about tech. There's been a lot of thinking about where you're taking us there, Lizzie, with the optimism around the global equity story. There's been a lot of optimism in the Asia tech space, and part of it has to do with some company specifics, and part of it's just the broader Iran story. OpenAI has raised $122 billion in new funding, valuing the company at $852 billion, making it one of the largest fundraising deals in history. It's backed by Amazon, Nvidia, and SoftBank, and the move underscores strong demand for AI, even as costs to scale the technology continue to rise. For more, we're joined by Bloomberg's executive editor for global tech, Peter Elstrom. Peter, nice to have you with us. So how significant is this funding round and this epic new valuation?
Well, we get used to these big numbers in the AI world, but let's just pause for a minute. These are really staggering figures. You said it's one of the largest fundraising. We can just say this is the largest fundraising that we've ever seen in the public markets or in the private markets. $122 billion. It's really staggering. You're talking about Amazon putting in $50 billion, SoftBank and Nvidia adding another $30 billion. Most of the venture capital world is participating, or many of the most prominent firms, including Andreessen Horowitz, there's MGX, there's also $3 billion from individual investors here. So it's really a lot of money that they're raising at this point. And also pause for a minute on the market valuation that you've got, $852 billion. There are only 14 publicly held companies out there that are worth more than that. So it's really reaching into the stratosphere, and this is for a company that's very young. It's losing tons of money at this point. It really hasn't proven its business model, but it's able to raise this kind of money. And partly it's because it's burning cash so quickly. It's burning about $1 billion a month. It's really trying to do three things at once that are very, very difficult. It's serving customers with their AI model with ChatGPT. They're trying to build this enormous infrastructure across the US and the rest of the world. And at the same time, they need to innovate and come out with these new models that are going to be better than the similar offerings from Anthropic, for example. So those are three things. They're burning tons of cash at this point. They probably need effectively all of that money to do what they need to do by 2030 here.
So in terms of how OpenAI will use this money, Peter, most of Amazon's investment is contingent on them either IPOing or reaching artificial general intelligence. What's the bar for that? What does it mean?
Right. Yeah, that's a very good point. Amazon agreed to invest $50 billion, but a lot of it is contingent on reaching these benchmarks. As you say, are they going to reach AGI in the next few years? They have to get there. They have to go public. Now, OpenAI is planning on going public later on this year, but as you guys were just talking about, The markets are pretty tumultuous at this point. Also, if they go to the IPO route, they're going to be competing with Anthropic, which also wants to go public. SpaceX, which includes XAI these days, wants to go public too. So it's a bit of a rocky road. They have a lot to prove here to be able to get all of that money.
Yeah, and let's talk about the wider moves we're seeing in markets today. Then, Peter, we've seen chip stocks jumping certainly through the Asia session, now into the European session. A lot of this has to do with just the underlying positivity that we're seeing in markets today around the Iran conflict, but also I think memory pricing and some data we got there crucial to the Asia story.
Yeah, that's exactly right. Because there's been this big build out of AI infrastructure, they need a lot of these memory chips. So we've seen companies like OpenAI, Amazon, Alphabet scoop up tons of memory chips that they want to put into these data centers. That's put a squeeze on the pricing because also smartphones need memory chips, laptops also need them. So you've seen this squeeze and prices have just gone up exponentially over the past few months. That had led to this big trade driving up memory stocks in a lot of different sectors, including Samsung, Hynix, but even some little known ones like Kioxia in Japan has gone up a huge amount in recent years. So we saw some of that air come out of the trade with the Iran wars, with some concerns that maybe the spending wasn't going to be as aggressive as it has. But now that we're looking at perhaps some sort of truce in the Middle East, or at least Trump claiming that he's going to be able to get out of the conflict in the next couple of weeks, again, there's this squeeze that could drive up prices even more.
Peter, thank you very much. Bloomberg's Peter Elstrom with the latest on those tech themes. Let's pivot to some of the geopolitical read across we've seen from perhaps what's been going on in the Middle East into some of the European capitals. And I'm thinking here of Paris and things we've seen in Paris over the last week. French prosecutors are seeking charges against 4 people over that attack attempt that we saw against their Bank of America offices in Paris. They're seeking terrorism-related charges. And also interesting here to note that these charges involve 3 minors and 1 adult. So we will see, we'll keep across all the details, of course, and hope to get to the bottom of what was driving that.
Let's take a look at what else we're watching throughout the day as well, Anna. At 10 a.m. London time, we have euro area unemployment data. At 1:30 p.m, it's US retail sales numbers. We also have Fed speak from Alberto Musalem and Michael Barr. And then, as we were discussing, we're expecting that Artemis 2 launch to take place at 11 p.m. London time. And then if you're up late, we have at 9 p.m. Washington time, 2 a.m. London time, President Trump delivering an address to the nation on Iran.
Right, so 2 very different events to look ahead to, hearing from President Trump and indeed the Artemis 2 launch. Perhaps we will, we'll certainly be looking ahead to what President Trump has to say with regards to markets. And let's talk about where markets head next with Bloomberg's Morwenna Coniam from our Markets Today team and things that they are watching on the blog. Good morning to you, Morwenna. This optimism, it seems pervasive for markets today. It started in the US yesterday, but US futures, incidentally, pointing a little bit higher, suggesting this has further to run.
Yes, so they're not pointing as high as we've seen the rebound today in European stocks, but as you say, we saw a bit of that starting yesterday. So it does look set to continue. We are seeing reasonably big gains in the stock 600 this morning, up about 2.7%. I think it is important to note, though, that when we look at how much retrenchment there's been since the start of the Iran war at the beginning of March, this doesn't even go halfway to repairing that. So it is optimistic, but it's not fully recovered by any means. There's still so much uncertainty. We have seen an element of sort of whiplash before in terms of how close to a resolution we are. This does seem a bit more concrete. We sort of have a bit more of a time frame for those intentions. But I think we'll have to wait and see, obviously, what Trump says later today. I think markets are sort of tentatively optimistic. We are seeing, broad-based rebounds. I was reading some of my colleagues mentioning that because volumes weren't actually that high in Asia today, it does suggest that it's a little bit of a shallow rally. It's not, fully priced in because oil has come back. It is below $100 a barrel. But it is still incredibly elevated from where we were.
And a lot of people on holiday, apparently.
What I really need to know, Morwenna, is my mortgage going to come down now?
I wouldn't be so sure about it coming down. But we are seeing traders really paring back their bets on hikes. I have to keep reminding myself we are now talking about hikes. For so long we were always talking about cuts. But there's now fewer than 2 rate hikes fully priced in for the end of the year. We started the week with, close to 3. So there's quite a significant retrenchment there. But we are still looking to tightening compared to the easing that had been expected, for over the past year. Actually, if you were in the US, then people are starting to add to their bets on the chances of Fed rate cut. And in the ECB, we're also looking at the tightening expectations paring back. So going in the right direction, but still not back where we were by any means.
So President Trump could yet get his rate cut this year. Morwenna, thank you very much for that. That's Bloomberg's Morwenna at Conium. As we're looking at Wall Street futures pointing higher, to add to the euphoria that we saw on Wall Street yesterday, we're up 0.5% on S&P evening, 0.8% on Nasdaq futures, and the stock 600 already up 2%. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI, entertainment,
and from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Stocks surge and Brent hovers around $100 a barrel on optimism the Middle East conflict may be nearing a conclusion. President Trump says the Iran war could end within 2 to 3 weeks and the US would leave other nations to resolve the Strait of Hormuz. Plus, OpenAI's valuation tops $850 billion after one of the biggest transactions in history, boosting its expensive push for more chips, data centers and talent. Let's look at where we are on a host of assets across a host of asset classes. This is the oil price. This is the oil price right now. We're down by 2.7% on the Brent price, just hovering around that $101 a barrel. Interestingly, WTI has dropped below $100 a barrel at 98.13. There's the oil price for you again. S&P futures then with all of that in mind and the positivity we saw on Wall Street yesterday that has since gone around the world. We do see further upside and US stocks are expected to go higher at the start of trade. The US yield in focus, yields globally in focus as we see bond buying continuing, yields coming down. Are we worried about growth? Are we thinking about the end of the war in Iran? All of that in the mix. And spot gold, interestingly, up by just over 1%. Let's have a look at how European equity markets are playing today's news flow. Is this just, quote unquote, a lot of short covering? Is there something more than that? Does it still tell us something very useful about the level of risk appetite we have in these markets today? We're up by more than 2% on some of these markets, including the DAX. Let's also talk about where we are on some of the key US stocks in focus. Nike out with numbers last night in after hours. We saw the stock slump by 9%. You can see in pre-market it is down by more than 9%. A gloomy outlook coming through from this sportswear manufacturer. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Anna Edwards, live in London. Brent crude has been oscillating around that $100 a barrel mark. It's down substantially this morning, down by 2.4%. In fact, we've seen the price of oil has been dropping. President Trump saying he expects the U.S. will end its involvement in the Iran war within 2 to 3 weeks. We have not had any confirmation that the Strait of Hormuz will be opened as part of that, but we will be hearing from the president later. The White House says that the president will address the U.S. nation, of course, tonight to provide an update on the situation in Iran. Let's talk to Bloomberg Horizons anchor Jemana Basechi, who's in the region for us, in Dubai for us. President Trump setting out a timeline there from the U.S. perspective, and Iran seeming to signal that they're at least willing to perhaps talk. What do we make of the latest news flow and how that's playing out then, Jemana, in the region?
Yeah, well, certainly markets are reacting to these comments that came through from President Trump overnight, suggesting a 2 to 3 week time frame by which they expect to wind up their military operations. Now, we don't know how concrete this time frame is, and indeed, over the course of the war, which has been going on for more than a month now, we've heard several timelines. It's sort of shifted as the war has evolved. But I think today the takeaway is that there is optimism that the U.S. may be thinking of ending their military operations because, according to President Trump, they have achieved most of the objectives that they set out to achieve, including the main one, which is ensuring that Iran doesn't develop the capabilities of a nuclear weapon. Now, what was not mentioned was, number one, the fate of that enriched stockpile. So, again, there was no comment about that. It will be interesting to see whether it actually comes up in his address this evening. And the second point is he's sort of delinked the military objectives to the reopening of the Strait. And this is sort of in line with the reporting that has come through in the last 24 hours, in which it seems as though the U.S. now thinks that this is a broad global issue that needs to be resolved as opposed to a U.S.-specific issue. And there's some questions as to whether or not other countries around the world, including some of these Gulf nations alongside European nations, would actually be willing to form a coalition to help reopen that strait. So that's one question mark still outstanding for where we go from here. And then final point, Anna, is let's not forget there are more military assets still arriving into the region. We spoke about this on Friday, that first Marine Expeditionary Unit arrived to the region, and then Bloomberg reporting overnight that another aircraft carrier, the George H.W. Bush, has left California now, is on its way to the region as well. That will take another 2 to 3 weeks to arrive. So there's still a buildup of military assets. At the same time, the strikes and counterstrikes overnight have continued, and it's been a very actually intense 24-hour period for many of the Gulf states with incoming projectiles.
Yes, and with that in mind, Qatar saying that a missile hit an oil tanker as strikes, as you say, continue, Jemana. Take us into a little more detail around the role that we might see the UAE playing. We've seen the Wall Street Journal reporting that the UAE is preparing to help open the Strait of Hormuz by force if necessary, which would be a big step, wouldn't it? It would be the first Gulf country to really get so involved.
I think what's clear from all of this is an outcome in which Iran still exerts sovereignty or control over the Strait of Hormuz is not an outcome that's acceptable to Gulf Arab states, and indeed probably not to any nation around the world. We need to go back to the status quo that existed before the war, which allowed for the safe and free passage of vessels through that Strait of Hormuz. So Wall Street Journal reporting overnight that the UAE, and perhaps alongside support from Bahrain, will be putting forward this motion, a resolution at the UN Security Council to potentially get involved with reopening the Strait of Hormuz by force. And it's unclear exactly what that would mean, but the idea would be for the UAE to assist the US with any military operations should they want to get involved in reopening the strait via naval escorts, via military operations, via using some of their bases as launch pads, perhaps to launch some of those operations, even going as far as taking over some of those little islands that are situated close to the Strait of Hormuz. But I think the takeaway from all of this is that there certainly is a lot of work being done behind the scenes on how you can bring together a group of nations, and perhaps not just the US alone, to come to some resolution for the Strait of Hormuz. If it's not diplomatic, then it will probably most likely have to be military.